obviously there's been a volatile element that has come into the AI sentiment here.
Absolutely.
A lot of it is centered around Oracle and sort of funding of these projects, private credit and its involvement in all of this. Like, what are your thoughts on this?
Yeah, I mean, we've definitely seen some concern building, kind of within the markets, just in terms of the amount of capex that is being committed. Kind of Oracle and the OpenAI kind of side of things is really where kind of that concern has kind of resided, and you've started to see kind of like an OpenAI complex and a Google complex kind of start to form within the marketplace, right? And you're kind of with the Gemini model coming, kind of bursting onto the scene, and then the Google TPUs, right? You've started to see, some rotation even within, kind of the AI complex. But the fracturing of the AI story in some ways is driving, kind of broader rotations, kind of within the marketplace, right? So AI has been such a big driver of U.S. market performance over the last couple of years. You've had these, kind of fits and starts of, kind of rotational activity, right? And now you're once again kind of seeing one of those. We'll see if it can continue, as we move into 2026.
Yeah, I mean, I think that's really the big question, right? I've seen sort of an increase in at least rhetoric and talk about diversification, about hedging. People not saying sell all your AI stuff, but like maybe buy some other stuff also.
Yeah, and I think that that makes some sense, right? The difficulty in U.S. markets is just that there's so much concentration at the top end of the indices, right? So it's very hard not only to kind of avoid, kind of the AI stocks, but that AI theme has, kind of really broadened out, beyond just technology, right? It's now very much driving performance in utilities and industrials, right? So you've seen even that just the AI factor is such a big driver, kind of in U.S. markets. But, if you look at kind of the overarching backdrop, kind of outside of AI, right? You have a reasonably positive, kind of backdrop heading into 2026. You have kind of reasonably supportive monetary policy, some fiscal, supportive fiscal policy, right? And then the setup is kind of similar to what we had coming into 2025, where you have earnings expectations are looking for kind of mid double-digit kind of return profiles for kind of small, mid, and large caps, right? So it almost once again kind of becomes a prove it story for those small and mid cap companies. This year we did see small caps kind of hold the earnings estimates kind of going throughout the year. Mid caps didn't quite do that, but it's that prove it story. Can you deliver, right, that earnings growth profile that markets are looking for, which will help kind of continue to drive some of that rotational activity.
And how much of all of this is contingent upon the Fed cutting in January, for example?
Oh, I think the expectations for a Fed cut in January are pretty low, right? But I think it's the idea, right, that you have a central bank that is going to kind of remain supportive on the dovish side of things. Maybe kind of two cuts, kind of through the remainder, two and a half, two, three cuts through next year. And then you also, there's a lot of argument about what they did in terms of balance sheet management, but that is injecting some liquidity back into the system. So for risk assets, right, that does tend to kind of put a bid underneath the market.
Does it feel like there's a Santa Claus rally coming at this point?
It's a little bit dicey, right? We are kind of turning that corner where we're in that final 2 weeks of the year, where kind of the seasonals do get pretty positive, right? It seemed like yesterday we finally had kind of the tech stocks, which had been under pressure, seemed to find their footing a little bit. This morning's story kind of once again kind of undercuts kind of some of that, and it is it becomes harder for kind of the S&P 500 if you don't have supportive tech kind of into the back half of the year, into the final 2 weeks of the year. But in general, right, I think that the backdrop is pretty positive. The one I think there's two things that I have caution around, right? A, sentiment, and kind of positioning. If you look at kind of the Bank of America survey that was out yesterday, right? So that's a little bit concerning. And then if you kind of look at kind of the 4-year presidential cycle, and typically kind of the midterm election year does tend to be the worst year of that 4. So that does give you a little bit of pause. But if you think back to kind of how a lot of the seasonals have played out kind of throughout this year, they haven't necessarily kind of gone true to form. So.
All right, well, we'll see what happens then. Thanks, Mike.
Thanks for having me.
Good to see you.
Good to see you as always. Big fan of your work. Love the research you were doing, looking at some picks going into next year in the energy space. How
Thank
should
you.
people be selecting stocks based on this massive data center build out we're seeing in this country?
Well, thanks for having me back. I have a pretty unique and contrarian view than most, which pretty much disagrees with most strategists and economists, which is I actually think that if you believe that the world is moving to a multipolar economic system from a unipolar system that we've enjoyed over the past 80 years, then what that means is that the US is going to have to re-anchor around energy and power, and in particularly power, as your last guest was talking about for nat gas and electricity generation, of which data centers are a big driver, but they're not the only driver. So as you think about the US, where we've offshored a lot of production, and the attempt to bring back semiconductor fabs like TSMC in Arizona, or steel mills, or shipyards, the things that President Trump has been talking about in terms of foreign reinvestment in the US, all of that is going to require firm baseload. And that is the big shift that's occurring. And there you have coal, that's unpalatable in terms of building new coal plants like what China is doing. You have nat gas, the primary solution that we see is the winner in the near and medium term. And then you have nuclear, also a beneficiary there in an administration that's very pro-nuclear. All of that rolls up into really a re-anchoring around physical, which we have not seen in at least 40 years. So that to us says that GE Vernova needs to really be a core holding in any large cap growth portfolio. And we had that as last year's winner, which returned 88% for our top pick. And we're choosing it again because even though the stock has run quite a bit, we actually think the opportunity is still being underappreciated, particularly in terms of the scale of the new orders, but also the service contracts that layer on top of that and the switchgear that needs to be associated with all of that. So when we look at that together, we see a very bullish outlook for GE Vernova.
Jed, let's just stay on GE Vernova for a second. I can tell you, and I know this is not the case, but people hear GE, they're still thinking this company's making light bulbs and appliances. You and I both know that's not the case. They've split the company up. Next year, what are some of the biggest catalysts for this company, GE Vernova?
Yeah, I mean, I think continuation of the current trends, which is largely, so this quarter alone, they will have usurped all of last year's orders for natural gas turbines. 50% of all electrons, if you exclude China, in the world are generated through a GE turbine. And so as you take that gas, you have simple cycle and combined cycle. And what we've seen so far is more of the simple cycle, shorter time frame to get up and running in the permitting. And we're going to start seeing the combined cycle, so this will generate a lot more power, start to roll through. They've quietly doubled capacity from 50 to 100 now. And then, as I said before, on that power side of the business, by the way, you've also seen pricing that's tripled over the past 3 years, from $800 a kilowatt to now $2,400, $2,500. But none of that really incorporates the service side. So each one of those new turbines is going to come with a service agreement. Think of this as like the agreement you have with if you have a natural gas furnace to heat your home, or even some people have oil furnaces. They'll usually come with a service contract to make sure it's running at optimum levels. Well, these big electricity, combined cycle turbines, they also come with those service contracts. And so but the first outage isn't for 8 to 10 years. And so you start to build a recurring revenue model that's all very accretive to the overall business. On top of that, they're rolling in an acquisition of Prolec, which is not in the models, which will come in 26. And all of these plants are going to require switchgear, which is in the electrification business. And the fact that the wind business is sucking wind is actually a good thing for profitability for the overall business, because that was the laggard and was dilutive. So we see the trends of both electrification and power being the driver for GE Vernova.
I know you also cover Tesla as seen through the prism of energy. But this year, I have hopped on every single Tesla earnings call. I hear Elon talking about AI. talking about cars, talking about driverless cars. Should Tesla still be viewed as a good play on energy? And what is the state of their energy business at this point?
Well, I think Tesla is being viewed more and more on autonomy and energy. And I think with Elon's pay package, the expectations have shifted to, what are they going to grow organically, and what will they need to fold in inorganically? And I think that's what's driving some of the expectations, as well as is part of that automation, both with automated vehicles and going to driverless down in Austin now. Also moving to Optimus in terms of the robot and what that might mean. What is happening there is there's really a de-emphasis on the auto business, which we value in a sum of the parts analysis that we've published. It really only about $30 to $40 per share in that business. So, what you've seen is a pivot where, Tesla was looked upon as an EV company, and through the transition, you've really seen energy grow, also equal or probably a little bit worth more than just the auto business. And then really autonomy makes up, over 70% of that value today.
All right, we'll have to have you back to talk about some more of these picks. Jed, thank you so much as always. Appreciate it. What I mentioned at the top about how much concentration risk there is in the S&P 500, what does that mean exactly for investors as we gear up for next year?
Well, it's a great question, and it's great to be with all of you again. It's tough out there, certainly for active managers to try and own enough of those top 7 or top 10 names to really make a difference in terms of trying to keep up with, let alone outperform the S&P 500. So for multi-asset investors, I think it's just going to continue to be a challenging environment to keep up with the S&P 500. It's hard to bet against them, though. But I think for 2026, it's going to be less about valuation multiple expansion and much more about what happens to the bottom 490 or 493, however you want to calculate it. I think that market breadth story, it was a little bit elusive this year, but I think it's going to come to the forefront next year and make a difference for multi-asset investor positioning.
Amanda, that's good points. Is the sell-offs we're seeing in Oracle and CoreWeave over the past few weeks, is that the signal, Amanda, to investors to start lightening the load on the Mag 7?
I don't know that it's necessarily a signal to start selling. Again, we're not trying to bet against that story. It's very secular, thematic, long runway, still very much early innings. So we're all in on it. I think just the reality of where valuations have moved to is a little bit, I don't want to say nonsensical, but I just said nonsensical. It feels like we need to recalibrate a little bit. And so I think what's happening here is some seasonality, selling some of those winners and hoping that we get another crack at it maybe early in the new year.
Inez, this is all one big fat bubble, right?
Look, Sazi, like Amanda was saying, I mean, yeah, there is this concentration. And also Goldman Sachs just recently put out a note as well, talking about that concentration for earnings growth for next year and concentrated in the largest S&P 500, the largest 7 stocks of the S&P 500. However, like what Amanda was just saying, there is this expectation that for the other 493 that you will see a bit of an acceleration of earnings growth for those companies as well. So there may be a little tiny bit of broadening out when it comes to that. But a lot of this, of course, is the AI theme that we've been talking about. And this is what Wall Street has been bullish on, is this AI theme that AI-driven productivity will also be supporting earnings.
Important point here, Brooke, is that within these 10 stocks that have essentially taken over the S&P 500 and taken over the minds of investors, these companies have earnings. The earnings are good, and they're still accelerating. So I guess to Amanda's point, it's going to be hard to bet against these names next year.
Brian, but I think what the key point here that investors have really weighed in on is the future outlook of these companies, the guidance that they're putting out. And I think that's why we're seeing investors fall disappointed based upon what these companies say will be the end results, or what exactly the end result could potentially be for revenue when it comes to all the AI investments that they're currently making, the spending that they're currently doing. And that's why sometimes we're not seeing the same return that we see from other stocks, other investments, because of the fact that these guidance, these outlook that these companies put out just doesn't meet the very high bar that these investors have set for these sort of companies. And also, we are seeing a bit of different fold over the past 3 months. We've seen Tesla, Apple, and Alphabet outperform the broader Mag 7, and that's largely because of the fact that investors seem to be liking the way in which these companies are now pursuing AI. And so we're seeing this bit of a difference in what we're seeing in these latter parts of the month and maybe earlier this year, when we really saw Nvidia, Amazon, Microsoft, as well as Meta really lead the way within this AI tech rally, especially over the summer months.
What stocks investors have not thought a lot about, maybe they're doing so recently, and good for them to actually, doing their research on these stocks. It's the Dow Transports, like I just mentioned. Those 20 stocks have ripped higher, and I would argue the move there is less so about the economy. It's just these companies have reinvented themselves. They're AI plays. They've laid off a lot of people, so the profits for these businesses are good. Are these good names to look into here?
Well, I think it's a really interesting play for sure. I'll just say, as a general rule of thumb, any company management team that says AI on an earnings call or a conference call of any sort gets a couple of multiple points of valuation, multiple expansion, whether there's real earnings in the near term or not. So I think maybe take a little bit of it with a grain of salt here. But I do think there's tremendous opportunity, of course, in the transport space, autonomous freight and logistics in particular. I think the automakers are obviously there in a big way, but I think that next iteration of what does it mean for supply chains, logistics, predictive maintenance, fuel efficiency, smart infrastructure. I mean, the list could go on in terms of potential upside, margin expansion, and efficiencies to come from this. So I think it's very, very early innings. I think there's a lot of opportunity there, but I don't know that the earnings accurately reflect that upside yet. So maybe that creates an attractive entry point.
Amanda, hang with me here. Are you a big believer in this thesis? So we've gotten a bunch of rate cuts this year. Maybe we get one more in the first quarter next year. You have various infrastructure projects going on around this country in a very big way. Are the transports starting to sniff out some form of economic boom in the first half of next year?
Oh, I love how you're thinking about that.
I mean, that's why they pay me the big bucks, Amanda. I mean, come on, that's why that's why
I'm with you.
Yeah.
Let's get real bullish here this morning. I love it. We do believe that there will be an acceleration in economic growth next year. Certainly a function of some of the fiscal policy stimulus that's been passed over the course of this year, but hasn't fully been realized yet. So I think there is a decent amount of potential upside surprise and an acceleration in growth. I've been talking about and wishing for a mid-cycle reacceleration, like turning back the clock on the cycle as a function of this year and even next year. We started to get a little bit of it. With Q2 and Q3 have been definitely on that trend. So it's going to be choppy, not a straight line higher from here, but I'm with you in terms of an acceleration next year.
And as are you with us on the economic boom theory?
I actually am in that sense, and that's because of rate cuts that are expected, a dove that is expected to go into Fed Chair Powell's chair next year, and the fiscal policy that Amanda was just talking about. I mean, if you just take a look at some of the Dow Transport stocks that you were just talking about, I mean, you've got some of the airlines that are up. You've got also Uber that is up 30%. Year to date. And then I will also add something else, and that is energy costs. Those have been coming down, and that is like a tax benefit to a lot of these companies, and that's expected to continue going into next year.